Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
G'day, how you going? Phil Tarrant. Welcome to the Pure Property Podcast with Phil Tarrant and Paul Glossop. We're back in the studio recording literally a day after the Reserve Bank of Australia handed down another interest rate cut, which I know property investors right across the nation were pretty happy with. We're down to 3.6%. Some pretty sharp rates going around at the moment. We can have a bit of a chat about that today, but we're here to engage, connect, regale some of the news that we've been watching over the last period of time since we last got onto the podcast a month or so ago. Paul, how excited are you about an interest rate cut?
Oh, look, as Big Kev famously
how many
once
bottles
said,
of Monsignor champagne did you?
Monsignor. Oh, for those Audi listeners, you know exactly what Philip's talking about here.
The greatest of all champagne.
The greatest. And it's a good hybrid blend between Flavor Flav and finding that budget sensitive.
Well, there's a lot of value in Monsignor.
Oh, no diggity.
It's Gee, by the way, you see Snoop Dogg is...
I did. And it actually...
Is that No Diggity? That's not Snoop Dogg.
No, I believe
No
that's
Diggity.
not.
It's
It's Blackstreet. That was
Street.
Blackstreet for those who are listening. Probably similar vintage to us.
Diggity.
Everyone knows
Yeah.
the song. If you're
Yeah.
circa grew up in the 90s, 80s, you'd know it. But yeah, he did sign. That's a big signing. Considering, I'll tell you what, they always have done, and they continue to do sport better than anyone else, don't they? The Melburnians.
Well, I was actually down there the other week for the
for
the
sport.
rugby.
Look at you.
Yeah.
Venturing out for someone who I know cares as little as possible about sport as any red-blooded Australian male possibly can, to see you get on a plane intentionally to go and watch sport played in a miserable loss, by the way.
Yeah.
I'm not going to bore our listeners to death with a failing sport such as rugby union. And as a previous rugby union player, I do enjoy the game playing it, but I tell you what, it's hard to watch.
Hard to watch.
It's
Oh,
been
they
hard.
come back in the
It's been
third.
better the last 24 months. put
Well,
it
I
that
think
way.
the English supporters were the most upset about the standard of Australian rugby.
Yeah,
They're
was
saying,
better
well,
than what they expected
it's a
it to be.
foundational phase for Australia. They'll come good again, blah, blah, blah. And I just remind them going, well, guys, you need to get four nations together to get your best out of them
to
play
kind
one,
of beat us.
to play one
And
nation.
to let a referee
to-
basically make
yeah.
the decision
Yeah.
to finish the game.
Yeah.
No, I get
So,
you. It is a sad state of affairs. The Ashes is starting soon over in the UK.
So
I saw Pidge McGrath came out predicting a 5-0 whitewash there too. That'll get the punters all excited and revved up. Not that we're going to be able to watch it. It's going to be a god-awful hour that we're not going to be enthused.
You can watch
to
a
get to
highlight
watch.
reel.
That's typically what we do.
Which is quite
watch
easy
the mini,
to do.
The mini in the
The
morning.
mini's good.
Minis have been a revelation for those types of things. 20-minute mini in the morning, my boy and I. That's quality. It's quality watching time there.
All right. Whatever. That's cool. Yeah. Anyway,
that's cool.
but back to Monsignor.
Okay. Sorry.
It's a very important point because quality and value does the same exist in an investment property. Investment property is like a fine bottle of vintage Monsignor.
Is that a double entendre?
You actually get the fancy
Really?
stuff. Comes
Black label?
It's black label.
Is it actually? No doubt.
It's actually black. It's like a dupe. It's a dupe. It's a dupe of Bollinger. It looks like it. If you don't look close enough and you see it in a bucket, you go, "Oh, that's a good plonk."
See, this is your problem, I think, sometimes, Phil, is that you do so well in bringing down everyone's expectation. I think you're just a Westie who's done well, and you're getting through life, and you sort of still got your roots there. But you use words like dupe, then people think, oh, he knows what he's talking about. He's talking about Audi. He's talking about black label fancy champagne at Audi, and then relates it to a bottle of Bollinger.
Yeah.
It's it gives everyone just a little Jahari's window into really what's going on there. I think I reckon we've lost at least half the listeners in this opening 5 minutes. So apologies to everyone here.
Well, it's actually a property podcast.
Yes.
And for those of you who are tuning in on YouTube, welcome. How you going? You can see us planned and considered as you would expect. Excited about property investment, and I think people are getting a bit annoyed with me around property recently. I've been a bit humdrum and negative about it. And it's good for someone to be a bit contrarian about investing in property.
Okay.
Yeah.
I don't know about how the word recently comes into the fold.
No, always.
Yes.
Yeah, always.
Yeah. You're always getting upset. My portfolio is growing. I can't believe it.
Can't believe my portfolio's only growing. Funny though.
When am I going to see a crash?
This is interesting. I don't know if you've seen this yet, and you'll. This is probably for all our listeners. I got a valuation on doing some refinancing at the moment. I got a valuation on a joint in Sydney, and a valuation. I bought this place. Call it 16 months ago, right?
Right.
Got a finance. The finance come in at the contract price, which I expected
when you purchased it.
When I purchased it, with a major bank.
Okay,
I won't say who. I went, that's all cool, no worries. I thought, oh, look, it's probably grown a bit, knowing this area. So I sort of got a valuation on the desktop, and I went, nah, not happy with that. It's a sort of, you call it a prestige property.
Mm-hmm.
So I said, it's investment property, but it's a prestige property. I said, get him to do an actual val on it, like come down and check it out and all that sort of stuff. Met the valuer and sort of worked him.
Back to your roots there.
Yeah.
Worked him well.
Worked him well, like, explained to him all the stuff that I've done to it and how much money I spent on renovations and all this sort of stuff. Good wholesome stuff.
Yep.
Valuation come back, same as the purchase price.
Yep.
Hadn't moved 18 months, right? So subsequent to that, I went, that's an interesting story. I'll go to another lender, another major bank, and did the valuation, and the val come back probably, let me try and work out my maths, about 10% up on purchase price.
It's interesting, isn't it? And I'm just looking at the suburb.
1 week from each other.
Yeah, well, the timing makes no sense, and it's irrelevant. But I was just looking at the suburb, knowing where that property is, and I look at the data and the actual. I mean, this is probably an interesting one for everyone listening, especially in premium markets where there's very little comparables, and knowing that property, the comparables become very problematic because you just simply, it's so subjective in that game. And the actual data, I just looked at it then, minus 24%. Now, someone would say that's over the last 12 months. Now, you might think, wow, that is a genuine crash. It clearly hasn't dropped 24% because ultimately it's taken into consideration some $10 million plus sales and some $1 million sales, and how many happen when you've got a very low volume. It can distort those figures immensely. And you could have a 5-6 apartment block that's brand new sell out in that same time, and all of a sudden it'll skyrocket. Yeah. But I think that's the point, Phil, is that anyone who's buying with the expectation that they can do a bit of an arbitrage on purchase because they think they're bought well, you're still very, very subjectively at the eye of the beholder. And the eye of the beholder can be data. And if the data was anything, it'd say absolutely no chance, because based on what I'm seeing, if I'm sitting on the other side of the bank, I'm saying that property's worth less. So if anything, we might want a bit more money to bring up the LVR, or down the LVR rather. But you obviously have to get a physical person in there.
But you look at that suburb, you look at 3-year, 5-year capital growth, and it's a very, very good story. And I got a thing in my mailbox down there, which I collected, and it was from a major real estate group singing the praises of the suburb and how it's grown by 37%.
Well, of course they're going to sing the praises.
It's
of
funny.
Course they're going to, yeah. But, I mean, how do they distort those figures? That might be their sales over that 12 months' time as well.
Maybe. And this particular suburb now is selling stuff at 20 plus, right?
Yep.
And it's so the issue is it's hard.
Yeah,
it's hard. But the question therein is, are valuations stacking up at the moment on purchase prices with banks? Are you seeing that, or is there
That's a good question, Phil, because we play in the meaty curve, right? Like where we're buying predominantly bulk of our investments are in. When I say the meaty curve, I'd say that we're in that 500 to 900K price range, where most sales take place, and we're also buying in major capital cities. When I say major capital cities, in suburbs which have hundreds of transactions per year, so you see the line smoothed out dramatically. So the subjectivity, it diminishes radically. Now, the question of are we seeing vals stack up or not? It's over the years, and we've been doing this for so long now as far as buying in multiple markets, that we have seen not properties, but you see themes in markets where certain markets aren't stacking up. And that's either that the banks or the bank that we're going through at that time. Typically, it's not one bank though. Typically, it's all the banks are on the same page. That's when we start to see themes of certain vals not stacking up. And I can think of probably 3 major markets. And this will be eye-opening for most listening, because the time that we were buying in these markets, I would say we were early-ish, or probably not extremely early, but early enough to know that the data wasn't supporting the last 2 or 3 years worth of growth. 2015 to 2016, Hobart, I could almost guarantee that out of every 10 properties we're buying then, I would say 4 out of 10 would have a short val. Brisbane, and predominantly North Brisbane, Moreton Bay region, between circa 2017 and 2019, we were getting some properties, predominantly 3-bedroom properties that were smaller as far as 100, 120 square metre internal fibro 3-bedders. And they're only being bought for 350, 380 at the time. We were probably less than that percentage, but I would say 1 in 10, 2 in 10 short vals. Perth, between 2020 and 2021, when we were buying there, and again, 220 up to 450, we were probably getting 1 in 3 short vals at that time as well. And the theme that I usually find is that if you're early, then you do run the risk. And it doesn't matter how big or small the market is, that short vals can exist. Now, quite obviously, time tells the tale of each of those 3 markets. I would have proclaimed that each one of those markets have well and truly more than doubled since we've bought there. However, you do feel the pressure because clients come back to you and say, I've got 10, 20, 30 grand short on this val. Now I can make it up because I can tip more equity in or something to that effect, and we find a way. But sometimes we have to go to another lender. Sometimes we have to do a full valuation instead of a curbside or a desktop. There are different things that have to happen to get it going there.
Can you use the short form valuation through that finance cooling off sort of clause period to renegotiate, and you go back saying that the banks come back and it's 30 grand short, you need to come
definitely done it in the past.
Yeah.
Word to the wise though, if you think you can go and do a desktop val and you bought a property for 500 grand, desktop val says 480, and you go back to them and say, here's what the val says, 480, I'm going to pay 480, I'm walking away. It's if you're in a market that's quiet, by all means you'll have a chance, but the reality is we've done that in multiple times over the years. But when markets start to, I'd say it's harder now than it was 5, 8, 10 years ago, because once markets start moving, it's very hard for vendors to probably be completely benign to what's happening in the area. So they'll be like, that's fine, I'm not going to pull my pants down. I'm going to let this go back to market and I'll find another buyer, because vals rarely, unless someone's paid way overs, they should come in at valuation or somewhere close to.
Yeah, and this is sort of connected with some of the themes I want to chat to you about today, and this is what's making property news. As a lot of things moving in unison there, particularly around some of the numbers with capital growth values coming in recently, but obviously the RBA interest rate cut as expected. I actually think I called the last one where I said no cut, which was probably counter to, I think, nearly every single economist in Australia thought it was going to happen.
Did you get some money on that, Phil? Because you would have got some very good odds.
I'm not a gambler.
In what form?
I just
physically going into the tab and filling out a spreadsheet.
Mate, if I could go into the tab and drink a couple of schooners and dust a couple of lug busters.
dust the
mate, tabs used to
Gartner
be
holiday
tabs
50s.
used to be Gartner. God, yeah. Back in the good old days where
you could smell it. You could smell it before you got to your local shopping centres. Usually sat next to the local Coles or Woolworths or Franklin's back in the day.
Yeah. Franklin's. Whatever happened to Franklin's?
Yeah, good
Bilo.
question. Yeah, Bilo. Golo.
Could have all got bought out.
Remnants of the past.
Yeah. Yeah, blokes didn't smoke holidays. The Rothmans.
There was some Rothmans back there. Yeah.
Craven A.
Oh,
Jesus
they
Christ.
certainly are days that I'm glad they're not around anymore.
Yeah,
probably
God.
not ideal.
I remember going into discotheques as a younger person where people just punch darts the whole way through.
That
and you used to just, you wake up the next day and smell your clothes and just go.
You couldn't. They were useless.
It's just gone. Like, it's horrible.
Disintegrated.
Horrible, thank God. Smoking's bad for you, by the way, kids. And vaping.
Oh, that's the new one.
Bad.
No stench.
Yeah, it'll get you in the end. But so as expected, interest rates are cut. The notes coming out of Reserve Bank Governor is pretty much saying it's still cautionary. We don't know whether or not inflation is going to do this. We're worried about jobs data. Unemployment is increasing. Still a lot of concerns in relation to where the jobs are actually getting created, and it's all largely government-based jobs.
Real wage growth came out this afternoon, which was a very interesting one, which has actually risen for the first time, and I believe it was 5 years, which is that's an interesting one because you're starting to see that the inflation's starting to really probably bed itself into that lower end, and we're actually having a little bit more physical disposable cash at the end of every day, every week, month, year. And that's probably a big one that I find is probably the first time I've heard that in a long time. Now, 1 month doesn't make a trend, but it's a decent sign, I'd like to think.
Well, nothing's guaranteed when it comes to interest rates, but the sentiment is they'll keep falling a little bit further.
Yeah.
It'll be dependent on a whole bunch of other things happening, but you're getting retail rates now, I would imagine, with that cut sort of 5.5%.
Yeah, mid-5s, 5.7s now. Yeah, and that's the theme. And I wouldn't be surprised if we're sitting at high 4s to early 5s this time next year. Not penciling it in, but I wouldn't be surprised based on where we see it probably trajectory.
And the average is about 5.5 anyway, right?
It's somewhere about there, 5.5. So we're
moving into average territory.
Yeah, which is, it's good. Like we're not moving into this dangerous territory and assets are growing and we're sort of seeing prices of money half of what their long-term averages are. We're still paying probably slightly more than our long-term average, yet the property market's been resilient. The economy's been pretty resilient. It's
considering.
Considering. It's. I mean, you're not gonna necessarily proclaim that it's perfect, but the soft landing, as I'm looking at that Qantas A380 in the background there, the soft landing's found to a degree. I think we've sort of found that happy medium where we had to have a bit of hurt, and there's certainly been a fair bit of hurt over the last 2.5, 3 years, but it hasn't been universal baseline. Everyone's suffered, and we've now got to figure out how to dig ourselves out of this hole. It's been pretty slow, and now I think we've found what is the bottom of where this cycle is going to go.
Well, what the Reserve Bank is really looking for is continuity in a equilibrium or status quo of the Australian economy. You don't want to be overcooking. You don't want to be underperforming. And they've largely manufactured it into that position right now. How long it would last, a lot of that will be driven by a lot of global factors, which will influence how they'll make their decision making. But expected to be at this rate for a period of time, I would imagine.
Yeah. With
view for it to be coming down. There's a whole bunch of armchair economists out there that'll speculate and pontificate about what all this means. Which for most property investors doesn't mean wazoo.
Yeah.
Is what do you do about it right now? And keep an eye on your interest rates. Make sure your lenders are passing them on.
Keep your lenders honest is probably the biggest thing that you need to be doing as an investor at this stage, and that probably first and foremost means a phone call to your broker to maximise what should or would be happening, and if it's not happening. And mate, that's probably one of the big trends I've seen over the last 6 or 12 months is a lot of investors have come off that fixed honeymoon rate of what they were back in the COVID days, and they expect that they'll revert back to a floating variable rate, which is what we've just discussed, say call it 5.5 to 6.2%, somewhere in there, but they don't read the fine print, they don't ask that question, and their reversion rate ends up being high 7s, early 8s. And that's one theme that I've actually seen happen dramatically over the last
You've got to fight
years.
hard for that, right? And that happened to me with a lender probably a couple of years ago where it come off a fixed onto a variable. I just went, right. I knew it was happening, but I didn't look at it. I just assumed, because I had a whole bunch of other loans with this same lender,
right thing.
That'd be the same thing. And it was a major bank. I won't say who. And I was just like, come on. And I was a private bank customer as well.
Yeah, it doesn't mean anything. It does not mean a thing, unfortunately. And anyone who thinks they're getting favours, just think again. So hence why, and when I say make a phone call to your broker, if I'm honest with you, a good broker should be making that phone call to you. They should have these dates penciled in, and they should know within a month or two of your fixed rate falling off to where it was going, they need to be getting in contact with you saying, hey, do you realise this?
It's a black hole, right? And this is why you need a good broker, because the broker doesn't know your interest rate.
No. They don't.
And it's hard for them. It's not like they can go, I know Phil Tarrant, he's current
they can't look up your file.
They're going to know what the interest rate was at the time of
Correct.
purchase. They're not going to know. They can probably guess what it is.
Correct.
But it's hard for the broker to. And there's new technology now where you can sign some forms and they can get access to it, which a lot of people don't want to do.
Yeah.
It's hard for them to know. So they need to know it's coming off and they need to interrogate it. So if your broker's not doing that, you've got to query them, because the difference between paying 5.5 and 8.
That's massive.
It's a huge amount of money, right?
Yeah, this is thousands and thousands and thousands of dollars every single year that gets torched, guaranteed by a lot of people.
Yeah, and don't pay a loyalty tax to your lender either. If they're not shifted on their rates, like pressure them and move them if you can. But what an interest rate, everyone, you read the mainstream papers and go, the interest rate cut of 25 basis points on a average mortgage is now whatever it is in your back pocket every day. That's normally the headlines. But the key thing for property investors around interest rate cuts is that if you were sort of doing 90% lends and maybe dabbling around sort of second tier or non-bank lenders in order to get the finance to kick into gear, you might not have met the serviceability requirements of the lenders at that point in time. But now that maybe a year or two later, when you've got increased equity in the property and interest rates have come down, you may actually qualify for a more mainstream loan, which may come at a sharper interest rate. And that's often forgotten. No one normally talks about that, but that's where you can really move the needle.
And I think, mate, you mentioned like people need to be prepared to move banks. You need to be prepared to move brokers as well, because a lot of the time brokers just look at this as it's a too hard basket, and I don't want to shuffle or make a call to your existing bank to sharpen your rate because there's no real benefit in it for me. And I'm not going. Obviously, no one's going to ever say that to you. However, sometimes you get the feeling that some of the conversations you're having might be slightly too hard basket. And I would question if exactly your scenario, that's an extremely common one. Even if you go from an 80% LVR at buying the property down to a 70 or a 60 based on growth in the property and you only holding that asset at a interest-only period, your rents would have likely gone up in the last 12, 24, 36 months. Your income is likely increased a little bit in that time as well. Rates have definitely come down since they were peaking circa 2023. So there's going to be better rates out there for you if you've held a property for 2 or 3 years. I can almost guarantee that 9 out of 10 people who hold an asset right now who had a debt that was taken out 2 years ago or more, the rate that you could achieve elsewhere is likely better.
So the key thing is you've got to do the work though.
You've got to make at least a phone call to interrogate and ask that question.
Yeah.
Action item for everyone.
Action item for everyone. And, you contact the team here, editor at Smart Property Investment, which is where we operate. If you need some good recommendations on mortgage brokers, we know a lot of them, as I'm sure you do as well.
Absolutely.
So you can pass on those recommendations. Just reach out to the Pure Property team and ask that, because if you've got a broker, hopefully they're working for you. If you want to measure, people go, how do you know whether you've got a good broker? Expect a phone call from them at some point in time.
Yep.
Expect for them to be proactive when you're coming off fixed rate type scenarios and or there has been changes to the interest rate environment.
Yep.
Look out for that. That's
for
a good measure.
Yep.
Good measure. But one of the things that all property investors love talking about is how their property is growing in value. And we'll get stuck into what I mainly want to talk about today is around sort of capital growth and give me some insights on it. But, in what's making property news, Australian housing values have risen 0.6% in July. That's the 6th straight month of growth following a dip between November and January at the turn of the year 24 to 25. So a good run, 6 straight months. So is there a trend there? Well, yeah, you can start to have a look at that. Does probably go up always and forever? No, it doesn't. It does ebb and flow. So 0.6% in July. That's all Australia. So that's all Australia, which is like, you know what? Who cares?
Yeah. Oh, to a degree, yeah.
It's like the numbers. It's all Australia. That just means inherently property is.
Yeah. If you owned a REIT that was 10 million Australian properties, residential properties, then you've increased your value of your share in that REIT by 0.6% for the month of July,
which is not too bad.
No, it's probably an annualized rate of 7-ish%.
Yeah, and again, that goes back to the point around compounding capital growth, right?
Yeah.
But monthly gains are recorded across pretty much every region. Hobart, 0.1% is the lowest.
Yep.
And Darwin, 2.2% for the month.
Massive.
Bam.
Bam. Bam. Booming. Booming out of control. Darwin. Buy up Darwin.
Yeah.
Watch the voice grabs of that. People taking that there and putting it out of context.
I went to Darwin a couple of years ago.
Yeah.
Been to Darwin twice.
Hasn't changed much, has it?
Once when the Australian University's games was up there.
It's funny you say that, Phil.
I had a great time.
It was excellent time. I actually, I'm pretty similar to yourself. I think the first time I was there was under 15s, under 16s Australian Water Polo Championships. Yeah. And I was there.
Was Crocosaurus was there?
Yes, Crocosaurus.
Yeah. And and then I went again for work a few years ago. So, quite a big gap.
Get down to
between
Fanny Bay and
Fanny Bay. Fanny Bay. We actually stayed at Fanny Bay.
Of course you
we
did.
stayed at the
Fancy. At the Ritz.
The casino.
Yeah,
Casino's at Fanny Bay, isn't
Yep,
it? Yeah.
correct.
And had meetings in and around sort of the main town and stuff. And, and down on the water, there's another bit down on the waterfront there where all the new build type stuff.
Yeah,
I remember sitting there and I was looking at prices going,
It's cheap.
And then, 2.2%.
What's the population? What do you reckon the population of Darwin is, Phil?
Oh, well, from what I understand now, the suburb to the south of Darwin, which is North Palmerston,
right? Not Palmerston North to confuse our New Zealand cousins.
Yes,
it's North Palmerston.
North Palmerston. Yes. So I got that right.
Yep.
I think that is now bigger than Darwin.
Where it's
it's sort of like that. That's
I
reckon Darwin.
Suburbs.
God, Darwin is going to be. I wouldn't know. 150,000.
Mate, you're very close. 145,000.
Is it?
Yeah.
There you go.
Well done. But to put it in context,
about the same size as Ballarat, right?
It's still smaller than the top 20 suburbs in Australia.
Yeah.
Or top 20 cities rather than Australia.
It's a small place.
This is why when it gets
Great
mentioned
place,
in
small
this,
place.
you're like, it's small. In the context of everything, it's small. So that's the part which I don't want people to get, too radically out of control with thinking, wow, it's going to boom. Or it's smaller than a large number of markets. Townsville, Cairns, they're talking about these cities. It's small.
It's a small town.
It's a small
really
town.
nice going there. If you've never been there, it's.
But I guess what I'm referring to there is that when it does well, it's okay. But you also, and we'll go through some of this data because ironically, this actually feeds into what happens over the long term. But when they're small markets, your liquidity can actually be very, very tight and very hard to offload. And that's been a big problem with Darwin over the last 12, 15 years. Yeah. Is it's no demand and it's a small market and there's minimal transactions.
What I'd like to see, this is to our friends over at the Australian Bureau of Statistics, the ABS, what I would love to see, I doubt it exists. If it does, can someone please tell me, where they talk about and the numbers come out semi-recently, a month or so ago, about X% of Australians own one property, X% own two properties, X% own four properties.
Which is about the same trend.
It's consistent, right? Of the people that own between one and two properties, which I can't remember the number, was it 60 or 70%?
One and two properties becomes like over 90% of people. It's not 81 own one, and then it goes up to 90 own two, between 90 and mid-90s own between 3 and 5, and then the small.
It's a tiny amount more.
Tiny amount own more.
And this is people who own stuff in their personal names.
Personal
right? Doesn't count trusts.
Yeah.
So the thing in the paper the other day about this small bracket of investors that own all these properties in their personal name. It doesn't. I would actually like to see, of the people that own between one or two properties, as a percentage, how many of them were new build or off the plan purchases versus existing properties as a percentage. And I also like to see geographically where they're located. Yeah. And I would like to look at as a ratio of the aggregate number of people in it. For example, so if talking about Darwin, so if 90% own between one or two properties, how many of those people bought in Darwin as a percentage of that against every other capital? And I reckon you'll find clues and trends through this.
Well, the data exists, Phil, in a different way. It exists in lender data of investment versus owner-occupied data. So you actually find that the trends there are actually more specific to how many people bought as an owner-occupier versus bought as an investment on that particular property. And it's, as you'd probably expect, it
doesn't say where, though.
It gives you states.
I know.
Yeah, it doesn't say cities per se. But it will, I guess, where it comes back down to, though, is that the larger cities, i.e. New South Wales, or larger markets, i.e. New South Wales, as well as Victoria, they have a higher percentage of investors versus the other markets. But you're right in the sense that I don't think the data is probably rich enough. And certainly you talked about some new data that came out, lending data only today, talking about 40+% of all new build data is now allocated to investors. Finance is actually investor finance, which is certainly higher than what actually is happening for established property. So you'd have to think that there's definitely a correlation between off-the-plan property, brand new, and investors buying more of it versus established. And it comes back to a lot of the things we're talking about over the decades of the incentives, the unregulation, what can be promised, what can be said versus what's actually technically delivered. I don't want to go too far into that because it's a big rabbit hole.
I caught up with a buyer's agent today who's like, it's livid about off the plan or house and land sellers.
Yeah.
Like it's just going, whatever. And there's this new term now, and we're going to do a thing on it on the Smart Property Investment Show. I won't pull you into it because it's sort of quite entertaining. But a new sort of genre of investment advisors called property services. So they now they go. They're not saying they're a buyer's agent, but they say they essentially sit in the middle of a transaction to help people with the right advice to buy investment property, which is largely house and land or off the plan. So they're not saying now that they're
So what, like a concierge?
property marketers, right? Like project marketers is what they used to be called, right?
So what, they're just rebranding themselves because the
Property services, yeah. So it's a property services business or something like that, right?
Goodness.
So they're not saying we're a buyer's agent, but they're saying to buyers, yes, we work on your behalf in order to find you with the right property that suits your investment needs, which just happens to be, surprise,
It's brand new,
the stuff
4-bed, 3-bath.
the stuff that they sell, and but it's okay for you. Like, we're not like a buyer's agent, so you don't have to pay us. We can save you that money. Don't pay $20,000 for a buyer's agent because we were able to introduce you. This is the right investment.
And
for
they're
you.
an NGO. They're a charity, I'm assuming.
I don't know. Then they go, but because we know this is right for you and we can find you this stock, it's really, really good. That the builder will
buyer beware.
provide a
Buyer
they
beware.
will provide a commission like a mortgage broker. So you know how a mortgage broker gets a commission? It's the same thing. So anyway, this is out there.
And it's always been out there.
Yeah,
It's always been there.
It just comes
be
in
aware.
in different guises.
Yep.
But anyway, I'd like to see those numbers broken down. That you can have some fun with that. But yeah, we touched on it very briefly. I'll just talk about supply quickly. Advertised stock levels are lower, tracking 6.8% below the same time last year.
Yeah. And that's a trend too, because we've seen that's actually hovered anywhere between 4 and 7% in the last probably 4, 5, 6 months. So numbers are down as far as supply available to buy. If you just go as a raw bastardized example, total amount of property available to buy on realestate.com today versus the same day last year is down 6.8% technically is what that's telling us. And that includes brand new established apartments, houses, the whole box and dice.
So the question is it less stock there, or is it moving before it actually hits the advertise? Like, has the buyer's agent sector actually put a dent in that dynamic yet?
Yeah, look, mate, it's a
Because
transactional.
The buyer's agent would be the enemy of the listing platform.
That would be, but I don't know if this is taken from the listing platform per se. This is probably more a transactional number. So it's taken on actually how many contracts have exchanged, which can't be changed, whether it's bought offline, off market, brand new, off the plan, advertised for 1 million days, gone to auction. It would be transactions on contracts. So I'd like to think that's an accurate number and remain accurate.
So less people are selling.
Well, there's less property to buy, so yes, technically, and it might also mean that there is, as opposed to where we are as a total raw number of total people, like the population growth has certainly slowed down versus its dizzying heights of a few years ago as well. So you'd like to think that yes, less people are selling, there's less property available for sale.
Yeah.
Yep.
Well, they're trying to fix that. I hear they're going to bring back the baby bonus.
Oh God, yes, baby bonuses and mate,
More incentives.
abolishing first home buyer. Well, grant restrictions on certain limits, and the stamp duty limits in certain states is starting to increase. I mean, they're throwing everything at it everywhere at all times. I mean, even in New South Wales, as a part-time property developer myself in New South Wales, you're seeing that they've obviously changed this whole TOD, this transport orientated development scheme that would change. I mean, this was a big announcement at the start of the year, essentially changing zoning to allow more density in a whole bunch of areas. That was all good and well, but we had a really detailed podcast at the start of the year about that. And what does that mean? Well, some people won a little bit of lottery in property that they own, but it still doesn't mean more supply comes to market because it's still as expensive to build property. It's still as onerous to get it approved, et cetera, et cetera. Apparently, they're announcing now, New South Wales government, that there's going to be pre-populated, well, you can actually, for fun fact for anyone, you can send us an email at purepropertyinvestment.com or inquire at purepropertyinvestment.com if you want to see it. But they've got what's called, or they're releasing, New South Wales government's releasing what they call a pattern book. And I don't know if you've seen much of it, Phil, but I mean, I've actually downloaded heaps of them personally. But what they are technically is New South Wales government has partnered with some big firms, architecture firms, to put together a whole bunch of pro formas, which is essentially a full DA application on a regular block of land within R3, R2 zonings to look at how to build a duplex, how to build a townhouse, different setbacks, different depths, different heights, etc. So they're trying to speed up the process. But where I'm getting to here is that they're now trying to CDC application everything up to mid-rise 6-story apartment buildings, which apparently is going to be announced later this year. So expect to see by this time next year a lot more approvals, which you might not have even seen announced through local council for apartment blocks, up to six-story apartment blocks go through CDC, so private certification approved within less than 4 weeks. And that's the intention. So they're trying to address the approval process, whether that's going to address the cost. And this isn't just New South Wales, this is nationally. I'm personally going through a number of FISOs at the moment to try and build both apartments, houses, townhouses. Construction costs are not coming down, hot tip.
Yeah.
So
Yeah,
does the feasibility still work?
It
It can take 2 years less to do it, but it doesn't mean that the prices are still going to make sense to develop it. So you still can't. That comes back down to labour costs, comes back down to material costs. Obviously, the price of money helps. If that comes down, that helps a little bit, but not heaps in the equation of it all. The holding time, that's one little element that we just talked about there. That will help, but it's 1,000 things. It's not one.
So CDC, like compliant development, that means you don't need to put it into council for approval.
Correct.
They essentially outsource that to a company who they
to a
say
private panel
is good.
Yeah.
And that's a bit grey as well, as they've cleaned that out a fair bit.
Exactly.
And the certifiers are probably a lot more.
Well, they go through a lot more rigor, but they get backlogged too. Then, all right, there's still only X amount of companies that are actually allowed to certify. So then all of a sudden, if more goes to them.
Yeah, I don't mind the idea of the patent book. Like
I think that's good. That's good. That's good business.
You got the patent book. You go, all right. So this tells me now I need to find a property that's at least this wide, this high, with easements not here.
Or if I own one that fits into this, then also there, right? And you can go and buy the plans for $1. Yeah. Which literally you can buy everything for $1 today.
Yeah.
Up till I think end of September.
Well, you don't go far. Just drive around to any place around sort of maybe the inner city suburbs or your equivalent in Melbourne. But there's a lot of houses that look the same. This ain't a new thing.
No,
right?
No, it's not.
Like, there's a reason why
go
every
to
single terrace.
Go to Europe.
Just there we go, build it. It's good.
Yeah, it's the same. Yeah. Just make sure the materials don't absolutely suck and that the actual foundational component and that there's a certifier who checks out to make sure these things are going to withstand a good 50, 80 years of time because that's what we do need. But there's I think there's some positives in that, but it's not going to change, I don't think, necessarily the cost and therefore the supply.
Which means there'll be ongoing capital growth.
Which means that this supply level is going to remain somewhat tight for a long period of time, and capital growth will continue to move in the same trend it has over the last 40 plus years, at least over the last 25 years.
So let's talk about capital growth. So this relationship between capital growth and yield, and you ask most property investors why they're investing, they'll say, I want it for capital growth, or they'll say, I want it for yield, and probably speak to a guy like you or me, I go, I want both.
Yep.
Sometimes both is available, but it's normally inversely connected. So if you're chasing capital growth, often you don't have the corresponding yield, and you can find really good yielding properties, which may not give you the capital growth. For example, Broken Hill, you can get some pretty good yielding properties.
Excellent yield.
High percentage. You might not get a lot of capital growth.
You might not. You haven't.
So there's a relationship between it all, and there's sometimes talking about Darwin as in a bubble at 2.2% for the month. You say, wow, that sounds like a hot spot, and you just don't know what's going on. They could have just sold a crap load of more expensive places and skewed the numbers, right? With a population of only 145,000, not a lot needs to happen to actually move the number.
But it doesn't take a genius also to jump on realestate.com right now and go on to any suburb in Darwin and just zone out and look at a heat map on realestate.com or Domain as an example, and look at those little bubbles that come up if you just want a house for sale. And I can almost unequivocally guarantee we're recording this in August. If you're looking at this in August or September 2025, you will find that at least half of those bubbles will say under offer.
Yeah.
So the supply is bugger all, and the sale is happening immediately. It's not dissimilar to where Perth was probably a little bit still now, but certainly last year and the year before, where you could see things that look like they're for sale, but they were done. And that's all good and well. It's happening. Supply is extremely low. Growth is happening, but it's happening in isolation versus what has happened over the last 15 years. You've got to put it in perspective.
Yeah. And capital growth is a product of many different things. However, are you better off having a sort of cheaper property or more affordable property growing at a higher capital growth rate than a more expensive property growing at maybe a slightly smaller growth rate? And these are the questions and decisions you need to make. Paul, we'll go through some numbers here on the average annual capital city growth over the last 5 years. So 2000 to
25 years.
25 years from 2000 to 2025. And you read this and you go, it's not a bad asset class.
Well, yeah. I mean, you put it in perspective. I mean, what this doesn't show is put leverage onto this. That's when you start to think, wowza, that's radical.
Yeah. On the basis that the yield will support holding property, but leverage is a great thing. It's so we'll run through them. Number one, so the highest average annual capital growth, compounding average annual growth. So it means over time, this is what it does. So 1 year it might go really big, might be flat, might be up, down. Melbourne at around 8.1%. So that's just crazy.
Yeah, it's a huge number, and ultimately this is where I think people need to start looking at long term as opposed to worrying too much about short term, because places like Melbourne and broader Melbourne, sort of Geelong down towards Ballarat, even some of the other markets of Bendigo, etc., they don't fall far out of this same equation where you can look at the last 5 years being extremely average. Last 6 months starting to show much better signs, but if you bought a property in 2020 and you hold that today, and we'll go through some numbers in a second, you'd be one happy camper, because I can assure you that 8.1% compounded over 25 years is a very big number.
And to be fair, it's pretty tough to get those sort of compounded growth numbers in other asset classes. You can find it, and a lot of people will point to the share market.
Yep.
And you'll go, that's cool. Yeah, if you actually bought and held those stocks for 25 years.
If you bought the ASX 200 and you bought it in the same time, you'd get about the same return, maybe even slightly higher.
And this is the point, on the basis that you
held it and reinvested your dividends back into it. The beauty about property is that you don't have a choice of reinvesting. So the compounding happens. So if you can get paid out, you don't have to make the choice to then buy it back and keep building the asset. The asset stays.
So 8.1% year-on-year growth, compounding average annual. That's not too bad. Sydney, 7.6%. Hobart, 7.2%. Canberra, 6.8%. Brizzy 5.9, Adelaide 5.9, Perth 5.5, and Darwin 5.3. Even Perth's a surprise there, isn't it?
Yeah, well, but I mean, this is...
10 years of really quite nothing going on.
Yeah, and I think more so I had an excellent 5-7 years in early 2000s as well, and then I had absolutely nothing, like you said, for more than 10 years, and then it's had an excellent, again, 5 years. But when it comes down to why we buy property, these are the numbers that people should be reminding themselves, is that you can look at your realestate.com value estimate on the property you own every week, every month, even every year. It's semi-irrelevant for me for the most part, because if you're looking at getting an outcome in that 1, 2, 3 year time frame, you're missing really the point here. And you can get really good outcomes in that time. And we've certainly worked on hundreds, if not thousands, of deals which have had 3-year outcomes which have been north of 50%. But it's not what we bought the property for. You're buying the property for that, even as low as 5.3, as high as 8.1% compounded over that time. That's when the magic happens. You're going through 2 cycles, 3 cycles, and you've got to be patient to get that outcome, because you will find in that 25 years, there's going to be 5-year, 8-year, even up to 10-year periods where nothing happens at all. And you can make the decision to sell and recycle, and that's okay sometimes, but a lot of the time, patience is going to pay off better than any kind of activity will.
Patience is key, and when I sort of start getting a bit fatigued about property, I forget about it. To reassociate myself with property, or maybe recalibrate my attitude towards it, where you just get in the doldrums of like this going wrong, that. You just go, why am I doing this crap? Or the interest rate's going up. I normally pull out my capital growth calculator, and it often helps me.
The Philabacus.
get me back, get me back onto on track. And you got some numbers here. Property bought in 2000 for $500,000.
So this is a Melbourne property.
A Melbourne property at 8.1% compounded growth. So you've held it through this whole period up until
and
today.
let's put this in perspective. If you put a 20% deposit plus 5% for closing cost stamp duty, so let's assume that that's 125 grand.
Yeah,
let's say 25%.
All right, so it's a really good point. So of the $500,000 to buy,
you put 125.
You put
of your hard-earned
$125K of money. So $125,000, right? That property today, and $500,000 in 2000 for a place in Melbourne.
A lot of money.
You would have. That would have been
it was probably double the average, maybe more.
You're buying sort of good inner city stuff, right?
Correct.
So, you could have gone in there for a lot cheaper is the point. But
we could halve this number and get the same projection.
125 grand, achieving 8.1%. And let's assume for really, really simple stuff, you had a 25-year mortgage, right?
Yeah. It correlates nicely.
So correlate. So you've paid that mortgage off, and we can work out what that would be. At 8.1% is worth $3 million today. It's
rounded
crazy,
down a little bit, but it's actually a bit more. But $3 million. So as a return, you're talking circa 27, 28 times your initial investment into that asset.
All right.
You've almost 30 bagged.
Yeah. Let me just get my interest rate calculator out. Let's just do this on air, right? So
okay.
So $500,000. So $500,000 purchase price.
Yep.
So what would the loan amount be at 80%?
Let's call it 480.
Okay.
400. So it'd be 380, give or take.
So 380,000 loan on a 25-year term, principal and interest, and let's say let's give an interest rate of
5.5%.
5.5%.
Probably go even more. Go 6%.
Let's go 6%.
Generous. Yep.
Yeah. Calculate. Okay, repayments are monthly, blah, 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 blah. All very nice. You would have been paying principal interest repayments, $2,400 a month, which is a lot of money, at 6%. Total loan repayments, $734,000.
Yep.
Total interest charged, $354,000.
Right? Okay. So that's write those numbers down, Phil, because at the same time you've been doing that, what I've also done is calculated what your rent would likely be on that property minus your ongoing average holding costs on that same property. So if I assumed a $400 a week rent,
I think what we need to do, we're going to look at that interest, what the interest was, right?
Yep.
Because it's what we're trying to work out is what is your actual return on this, right?
Yeah.
So, okay, what would have been over 25 years, how much would have you received in rents?
So rents, if you're getting $400 a week on a $500,000 property at that time, so I'll assume it's circa 4%, maybe a touch over 4% yield, times 52 minus about, say, 2 weeks of vacancy every year. And then out of that, I average 25% per year I take away for running repairs, council rates, water rates, property management, etc. Works out to be about 15 grand a year that you receive after all said and done.
$15,000 a year.
Yep.
Times 25 years is $375,000.
But that also doesn't account for circa 2% minimum average rental increase in that time as well.
So you got compounding rent on that.
Compounding rent. Which,
so even on that basis, if your rent didn't change, if your rent didn't change over 25 years, you would have generated to $375,000.
But absolutely, you would have.
Yeah.
Bare minimum.
So $375,000, assuming that you didn't get increased. So you put it in a calculator and work this out, model out 25 years.
Yeah.
So that $375,000 would have covered your interest bill.
Yeah.
For holding that property.
Exactly.
And you would have got taxation benefits from this.
Of course.
Everything else, right?
Yep.
So, but not even counting that. So largely, you put in $125K cash.
Yep.
And you've essentially turned that into $3 million
in value.
Now,
if you sold that property,
you're gonna get paid.
Yeah, but let's assume let's assume you sell it. There's $2.5 million capital gains. Yeah. Let's say you give away, worst case scenario, 25% of that in CGT, which you wouldn't. But let's assume worst case scenario, that's what you give away there. You give away 600 odd grand.
Yeah.
So you walk away with $1.9 million out of a $125,000 investment. You do that to the power of, you're talking 15 6x net return over 25 years.
Yeah, and it's all cash money.
That's literally landing in your bank
yeah.
account, and you do with what you want.
And that's the point, right? Like $354,000 in interest payments over 25 years, largely supplemented, or it's completely all supplemented.
Yeah,
supplemented by the rent you're receiving.
completely.
You know,
and I think this
and this is where, because probably it might start negatively geared, but it becomes positively geared. And this is just only
massively.
assuming it's becoming positively geared because you're driving the principal down, not because you're actually increasing the rent. So that would be a very different number.
Absolutely. And even if I just applied a average, and we've got an average chart of we'll go through all of those capital growth rates, because I know everyone wants to see what all those capital growth rates over the last 25 years have been in every city. And we've also done the average rental yield growth in every one of those cities, and you'll be surprised where those numbers actually land. But even on a $400 or $500 per week at the start, 2.5% compounded per year on rent works out to be about another $250 odd a week at today's numbers if you average that out. So it goes from, say, $400 to $500 to $600 to $700 a week, which is probably another 10, 15 grand a year on top. Yeah. But let's assume it's neutralized. And I think that's a big lesson for a lot of people who are buying for yield today. And we mentioned markets like Darwin, high yield, but when we go through those numbers, you realize that the 25-year growth has been very, very soft. And if anything, it's actually the worst performing capital city in Australia. Yeah. Rent yields, the actual cash flow on a property will historically increase, and that is going to be regardless of where you're starting. And the big thing for most people to be aware of is that rents will increase with inflation over time, pretty much in line with inflation. And history will show that. And that's not just Australia-centric, that is globally. If you're seeing CPI or inflation sit somewhere between 2 and 3.5%, over the long term, rents will actually keep trending pretty much in line with that historically everywhere you look. So if you're buying at a price point today and you're forecasting where's this property going to be in 5 years, 10 years, 15 years, you can pretty simply do your compounding numbers on rent, and you will all of a sudden see, hang on a second, I know it's negatively geared now, but am I buying a good quality asset? Can I hold this property at 5, 10 grand a year negative, knowing that rates have just come down a third time this year? There's every chance they'll come down a fourth, maybe a fifth or sixth time, but we're kind of already hovering around this average. So rates historically are probably in that sweet spot now that I can do all my math on. In 3 or 4 years' time, they're going to be neutral. And then from that point on, it's gravy. And then all of a sudden I can just sit back and I can literally watch my money grow. That's the part which I think most people need to be more focused on 5 years, 10 years, 15 years, because that magic happens on this compounding when you're getting way down the track.
Well, 2 things I would say, 2 observations. Number one, let the process determine the outcome. Yeah, and that's assuming you buy the right places, blah, blah, blah. And number 2, get in there as fast as you can.
Yeah.
And as slow you are in accumulating properties for whatever reason, it's just going to stifle your ability to realise the capital growth. Yeah. And this is like, paper profits, unless you pull out the dough, and to pull out the dough, you've got to pay tax on it. If you sort of set yourself up the right way with the right tax structures, you could maybe get a more favourable outcome in relation to that, but expect to pay tax. It's your obligation as a property investor. What keeps this great nation moving forward.
Shout out to everyone who's just done their BAS.
Yeah.
Yes. But I think it also shows, Phil, that you can sit here at 35, 40, 45, 50, even 55, and you could be thinking, oh, shit, have I run my time too late? And a lot of people, I speak to people all day, every day who you do hear it in their voice. They're like, I could have started earlier, but I kind of just faffed about. I pontificated, I considered, or maybe I made a mistake really early and I just got once bitten, twice shy. And it happens far too often. But if you're 40 years old listening to this right now and you're thinking, I want to set myself up for retirement, I guess I've got super and I'm hoping that'll do the job. Yes, you have it. And yes, that will keep working its way and keep doing its magic. And it's one of the better vehicles in the world to actually accumulate something that's going to give you a better retirement than what you'd otherwise have. But if you're buying an investment today and you wait till what is technically around about pension age now, that is 25 years if you're sitting here at 40 years old. So when you think, could this kind of happen to me? The worst out of that outcome, when we did the same runs on the board, if you bought that same $500,000 property in Darwin in 2000 and held it to 2025, and you got 5.3% compounded. And just for those listening, it goes 7.6 for Sydney, Hobart 7.2, Canberra 6.8, Brisbane 5.9, Adelaide 5.9, Perth 5.5, and Darwin 5.3, which we went through earlier. even if you got that 5.3 average annual compounded growth on that same $500,000 property, that property today is worth $1.81 million.
Yeah.
So you go back down, you put $125,000 on the line to get a $1.8 million return, minus your that, and we talked about the fact that your holding costs are essentially negligible once you factor in rental yield growth, paying down the deficit, and you actually get to the point where it actually costs you next to nothing that entire time when you average it out. You're still talking more than a 10x return over a 25-year period of time.
What you're doing there, and we've all seen the advert on TV that says, those two ladies with a superannuation, they sit on a park bench. This lady invested
You're
here
sitting on a monster
with WotC, and then this person invested with WotC.
Compare the
and
pair.
This is to compare the pair, and this is how it ended up. Well, it's exactly the same thing there.
It's
Where
exactly the
you
same.
choose to deploy your dough will make a tangible difference in the outcome in this regards to the tune of $1.2 million. Now, good luck. I'm going to get some hate mail on this. Good luck finding a property in Darwin in 2000 for $500,000.
Well, back then, yes. Now, you'll probably find a few of them now, but they're becoming few and far between even now. But
Well,
like
you
you
would
said,
have been able to.
you bought Fannie Bay back in the
You
day.
would have
You're
bought
saying
Fannie Bay back in the day. I love Darwin. Great spot. But you got to put things in a perspective as well, right? Like, back then you're probably buying in Darwin for 100 and something.
And I use these average numbers because we talk about it a lot, Phil. Like we've mused over it a lot when we consider, is it better off buying one really expensive property or potentially several properties at a lower price? And you can do this same algorithm. Say I may not have bought one property at $500,000, whether it's in Melbourne, Sydney, Darwin, or any of that back in the day. And we've talked about properties we bought in the western suburbs of Sydney back in 2010, 2012 for $250,000 and bought a few of those, equivalent of $500,000. We're going to fast forward to not necessarily now, but in 2035, these same numbers I can almost unequivocally say are going to play out. And those properties which you still hold, I still hold, I know the value of them. They are very expensive properties now. And we didn't pay much for them back then, but you don't have to buy one really expensive property, but you can also look at saying, if I buy well-selected properties, it can be two, could possibly be even three that make up the difference over time, but you also then have to balance the books on cash flow of what you can afford to hold at that time as well.
Yeah, you can put things into perspective, right? To actually get $125,000 together back in 2000, that's a fair chunk of fair chunk of coin, which would be sort of equivalent to what it is today. So that 125 on 500 there today, you're probably buying maybe slightly higher value properties. So your dollar probably goes further today than what it did back then if you're buying in the right locations. I'm not talking capital city locations, but so you did that and you invested $125K in 2000, worth $3 million today. If you still held that property, so $3 million in Melbourne today, a property of that value is probably returning you $1,200 a week.
Yeah.
In rent.
Yep.
Right. So $1,200. So to be completely unencumbered, right? Completely unencumbered, no debt on it. You're still holding today. $1,200 times that by 52.
60 grand a
That's
year.
$62K a year.
Yep.
Less.
Call it 45, 50 grand a year after all
some
your
stamp
fees
duty
and charges.
What do you call it? Now land tax and stuff and all that
property.
sort of stuff.
Yep.
So it's putting money in your back pocket, right? It's putting money in your back pocket.
Absolutely.
But say you wanted to liquidate it, and you're going to have to pay tax and stuff on it. I can't remember what number you come out with. To actually, if you pay agents' fees and capital gains tax, what are you going to be left with?
So 25% on your profit, worst case scenario. If we're talking about, say, the $3 million scenario here, I mean, you're talking that, what are we talking, minus 25% on your profit, first $500,000 goes down to $2.5 million. You're probably talking 600 odd grand in tax you give away. So best part of $2 million cash.
Okay.
And it lands in your bank account after you've paid for everything.
Yeah. So you're going to choose to keep it and get paid, or you get a couple of $1 million in your bank account.
And you might say that, and to that example, Phil, this is where we talk about this a little bit, but yield on current value versus yield on purchase price starts to then become a very big conversation for those transitioning, because you think, okay, well, 40, 50 grand on that asset that's worth $3 million doesn't sound like much right now. If you liquidated it and went down that pathway and you landed with the exact same property but put $2 million in your bank account, even if that bank account somehow you were finding a high interest saver account at 4% in today's money,
80K.
there you go. And that's zero zero risk,
80K.
zero overhead, zero hassle factor. So you could actually double your income by liquidating that property at that time as well. Or you could obviously find high yielding ETFs or anything else outside of that as
You'd
well.
be paying tax on that income, though.
Correct.
However, if you did this inside of your self-managed super fund,
Zero tax at pension
and
age.
you're past pension age,
Yeah. There you go.
tax-free.
We're solving the world's problems, Phil. One investment at a time.
Don't hate the player, hate the game.
and this is what it comes down to.
This is only one property we're talking about.
This is one.
Yeah.
Multiply that about by 2, 3, or 4, and you start to really think that is A, it's possible for many people listening to this right now, and B, I think most people probably just need to absorb the fact that time is your enemy if you don't act, but it is a massive ally if you just do 1, 2, possibly 3 or 4 moves that are half decent moves. They don't have to be the best. The worst out of all of the major cities in today's day and age over the last 25 years gave you more than a 10x on your cash on cash return. And if you extrapolate that over 3, 4, 5 properties and played the long game, you are made in the shade. And I say that a bit tongue in cheek, but it ain't much more complicated than that.
No, if anyone tells you otherwise, they're probably selling you something. So yield then, which a lot of investors chase.
Yeah.
So this is the what return you're getting on your investment on an ongoing basis.
On the day you buy it. Yeah.
Rather than, so this is the cash it returns rather than the cash flow that it generates rather than the asset value increasing.
Yeah.
Darwin, best performer at
3.6 compounded over the last 25
compounding
years.
Average annual rental growth. Hobart 3.4, Adelaide 3.2, Perth 3.1, Brizzy 3%, Canberra 2.8, Sydney 2.6, and Melbourne 2.5. So that's what your rent has been increasing in those markets
Every
compounding year on year.
Which is basically the CPI bracket, right?
Yeah.
Yeah. But I think what I've done there too is to say, okay, well, let's assume you had a starting balance of that same starting property of $500,000. And let's say it's one property, or it could be 2 or 3 properties back then. Don't get too bogged down in finding a $500,000 property 25 years ago. But it's if it was getting $500 a week 25 years ago and you applied the Darwin compounded of 3.6, then that works out to be $1,210 per week today. And if you look at that compared to the worst performing market, which is Melbourne at 2.5% compounded annually, and again started at $500 per week, that's $927 per week today. Yeah. Now, per year, I just did the math for everyone just to listen to it out. That's about 15 grand, a bit more than 15 grand per year difference on a Darwin investment versus a Melbourne investment when you look purely at cash flow. But as per that earlier compounded growth position, you have foregone $1.2 million in growth to get $15,000 per year better rent.
That's crazy, isn't it?
And that's where everyone should be having a penny drop moment to say people keep getting absolutely bent out of shape about yield. But once you get past that 2 to 5 year horizon, the difference of a positive, negative, slightly neutral, slightly positive, slightly negative, that conversation starts to become very minimal as far as what the difference is. And then you look at it and say, well, what would you, if you could fast forward 3 to 5 years and say, let's assume neither of those two options are going to cost you anything to hold, and one might make you $100, one might lose you $100. If you could get an outcome that's going to be $1 million plus better, it's a rhetorical question. Which one would you take? And everyone would be choosing exactly the same outcome. So I think people need to be guided far more by what those figures actually mean over the long term, as opposed to short term chasing yields for no reason other than I just need to be slightly more cash flow.
So the yield percentage is largely irrelevant. What is relevant is cash flow and how that supplements your ability to hold properties in the long term. So, if you spend less than what you earn, that means you've probably got greater capacity to hold negative gear property.
Yep.
And that will be a product of how many of those properties you have. It could be a different equation. Versus if you don't have a lot of surplus, then the cash flow becomes more important. The question is that how do you hold your properties to ensure the long-term upside growth you're going to get through capital growth?
Yeah.
That's what it's all about.
Absolutely.
So how do you hold your properties, And you see properties are often the last things people sell.
Yeah.
particularly family home, but investment properties is even through tough times like COVID and all the problems going on, people will work hard. And if you're constantly for 25 years struggling to hold on to a property, there's probably something a bit wrong with the property, I would say, because you probably bought the wrong property. There's some clues in that.
Yeah.
If it's still hugely negative after 20 years,
that's a big problem.
That's a big problem.
And there certainly are outliers, and I can think of a few different scenarios, i.e., I know we talked a lot about some of those high-rise apartments in the Melbourne market that aren't necessarily 25 years in the making yet, but probably like 10, 15 years and are probably still in that category. There's a few in other major cities. Typically, it usually comes back down to high-rise, off-the-plan apartments, unfortunately, but it's rare. Those examples become rarer the longer you hold. And we talk little bit about the CoreLogic pain and gain reports that come out typically every year, and that actually talks specifically to this about how long it takes on average to hold a property before it turns a profit. And you find it usually oscillates somewhere between 5, 6, 7 years on average. If you don't refinance. And that factors in your acquisition costs and your sale cost versus your sale price.
And all a refinance does often is just resets you, so you got to wait another 5 years.
Yeah.
If you're refinancing against, it resets it another way. And that's okay if cash flow isn't too much of an issue.
Yeah.
But what you see a lot of property investors do, they get to a point where they go, I'm going to preserve that property now. I've taken enough out of it. I'm just going to let it go and let it run.
Yeah.
Let it naturally shift to, principal interest after 5 years, and then often at that point in time the rent's increased, and you just do the maths, and it's probably not going to cost you too much to service it.
And there's a whole host of interesting ways you can use equity in the years ahead for anyone who's sort of starting to build their portfolio, or anyone who maybe hasn't already got 2 or 3 assets and sort of maybe 5, 7, 8 years into building their asset base. And I can speak personally. I bought a house earlier this year, and I'll be doing a knockdown rebuild. And I've had a meeting with my bank manager only a month ago and sort of talked about construction finance. And he kind of looked at me and say, why would you need construction finance? Aren't you going to be selling the house you're in and using that to then I was like, well, mate, I want to use leverage here. I don't want to use cash. Yeah. And then we went down the path of saying, well, you know what, maybe I won't get on this construction, because it was met with a bit of a blank stare, which I didn't expect. But what I've done since that conversation.
So what were you doing? So you weren't going to sell, you were going to.
I wasn't going to sell. I didn't want to sell immediately. And he was assuming I was going to sell and maybe rent and then build this house and take that cash.
Okay.
And I was like, I don't want to be doing that. I want to be living in my home until this is built, and then I'll move straight in. I don't want to be.
And keep the other one.
And probably not, but I mean, whether I do or don't,
debt, right?
whether I do or don't, it's kind of the bank sort of sees it as, well, you could change your mind 20 times between now and then. But I guess where the alternative has now come into the fold is that I've got assets which I own, which I haven't touched equity for quite some time. So instead of thinking, look, you didn't say it, but I could read the room.
Don't leverage that place, leverage something else.
Yeah, saying go and leverage your investments, because I can get you a rate that's going to be just an investment rate at, say, circa 5.6%, you've got a ton of equity there. How about I just top all your debts up to 80% LVR for you? And all of a sudden, ta-da, there's a facility that you can use that's still leveraged. But again, it's backed by my rental income, which has increased over the last decade or 2 decades, etc.
And you get the benefits of that being income.
Exactly.
Tax deductible. And you said a lot of people strategically do that. They just go, I can, if it's costing me money, that's fine. But if it's pre-tax, okay, I'll wear it. But that's okay, because in the balance of things, it'll all come in my favour. So strategically, a lot of people keep their investment properties at 80%, purely because it makes
free
sense.
Money. Well, this is it. I could sell those properties, take that profit, but in this facet, I pay no tax, and I up the debt. The assets have increased. I'm not speculating they'll increase. They have increased.
This is why, and it comes back to what's in property news. There's negative gearing's coming back into the equation. I see the ACTU National Secretary getting into it with all these smart people in Canberra doing productivity discussions, weighing into areas outside, I would say, would be their domain and their remit. But it's there again, it's coming up. And now you've got some new MPs coming out sort of going, we've got to start. It's wrong that people are making money off property rather than, there's this thing shifting from going.
But we don't have a solution other than we need a tax.
Why are all these people getting tax breaks over here and never gearing? But what about the positive gearers? They're not giving enough.
No, we're not. Let's up their tax, because we can tax them more. Oh dear.
Let's change things. Let's,
Phil for PM.
Yeah. God.
God indeed.
God
help everybody.
I think the world would cheer.
I don't know about
They
that.
finally got someone in the
Jeez.
seat in Canberra.
Holy heck.
Toe to toe with Donald Trump.
Yeah, okay. Well, I'll leave
Drink
you
a pint with Keir Starmer. Happy days.
I don't think Keir Starmer will be around for much longer
No,
based
you
on
reckon?
their reputation over there in the last decade or so.
Yeah, I've got some. Anyway.
But I think to wrap that up for those listening, hopefully there's still a few of you. As much as Phil's boring talk about Keir Starmer and him running for PM, etc., may send most of you over to the Audi Monsignor shelves. I think for those who are thinking, okay, it's time to make a move, third interest rate cuts just played out, probably another one coming sometime soon. The markets are growing. We've obviously shown by the data last 6 months, it's unequivocal as a trend. They're going up. And I expect that the next 12, 24 months, that's going to continue. Don't get carried away with thinking, where should I buy that's got the best rental yield? I think what we've tried to unpack there is saying that is a fool's gold scenario. Balance your yield, absolutely, but chase the best asset in the best predictable market you can possibly buy. And what we haven't touched on here, Phil, and I'm conscious of the fact that we haven't looked at our top 20 major regional markets in this set of data, and I didn't want to go too deep down this, but I actually ran that set of data parallel to this when I set this up for this podcast today. And I can say that the best performing top 20 regional market sat a bit below where Adelaide sits right now. And that was essentially Ballarat, which sat at about 5.8% as far as average annual compounded. And I went backwards from there. And I can talk about markets like Townsville, Geraldton.
So Melbourne,
Mandurah.
Sydney, Hobart, and Canberra, and Brisbane all outperformed. And Adelaide all outperformed.
The best of the top 20 largest regional markets. And again, like I can go really deep into that data, but it's probably a little bit too much. But it's probably for people to say, well, what about this market? What about that market? Well, to put in perspective,
the point there is price point, right? Like
correct.
You may not
Entry
be able to
price.
invest in those other markets.
You might not. You might not. So there are options, but I would say chase growth first. Look at balancing your yield second, and buy the best quality asset you possibly can that's going to fit that budget. And that's our job. Pure property investment, that's all we do. We don't look at saying, hey, we can get a 7% yield over here in Silverton because ultimately that's going to give you an extra $40 a week in your back pocket. However, I'll just hide that data that has done absolutely nothing in the last 45 years except produce a couple of Mad Max movies. And then ultimately from there, our job is to go and source, secure, and negotiate that property that fits that brief.
Sounds simple.
It is pretty simple.
I'm sure you've written all about this in your book, The Surfer's Guide to Property Investment.
I have.
The Next Wave.
The Next Wave. Audio book. You can actually buy the audio book now for less than $5.
Less than a cup of coffee.
Literally less than a cup of coffee these days. So jump on to purepropertyinvestment.com. You can get the audio book less than $5. You can get the paper copy book, just pay for shipping on exactly the same website. So if you're interested in some Father's Day gifts, stocking stuffers coming up, purepropertyinvestment.com. You can get in the mail just in time for Father's Day.
When's Father's Day?
I think it's first week of September from memory.
I need some socks and undies.
Well, you can get a book as well for those Tarrant family members who are listening who want to give a present to the fourth best father in the family. Feel free to buy a couple. We might even give you an audio book for free. Don't quite know how we're going to put that in the mail, but we'll figure it out.
All right, good. People want to track you down just on your website.
Purepropertyinvestment.com, inquiry at purepropertyinvestment.com, or they can give us a buzz 1300 98 5428. Phil, we are trained operators standing by, ready to take your hate mail.
Great. Well, thank you. Thanks for coming in. Thanks, everyone, for joining us today on the Pure Property Podcast with Paul Glossop. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.